podcast of the quarter of the month after the third quarter delivered everything possible, and I'm sure the fourth quarter will do the same. It seems that we are permanently caught in a somewhat uncertain space. We've had the announcement, of course, over the weekend that the OPEC has decided to call, not that it's an emergency meeting, or the meeting was always scheduled for October 5th, but they have called over the weekend for that meeting to take place in person. Let's welcome back to the table after an absence of a long summer holidays, shall we call it, Jorge Montemayor, president and founder of Global Markets. Welcome back. Jorge, your thoughts this Sunday morning as we reflect on the week past. Why has OPEC decided that they must all rush to Vienna and have a meeting?
Well, they have to make some big decisions, which in my opinion are a significant cut in production. The bottom is falling out of the market. I think we can all see that. There is a run on central banks, on bonds, on stocks, on oil, on commodities. It's a really bad story. What you're seeing here today is the new Jorge after the summer holiday. I am not bullish. I am a bear. The world is falling apart. I mean, I'm very serious. I have spent a lot of time in the past few months and really intensely in Singapore during the oil meeting, looking at where are the bright spots. And frankly, there is only one. If in the meeting in China, President Xi decides to open the economy and restore those supply chains and take a little bit of the foot of the state from the neck of the Chinese citizens. That's the only good thing I can see that could happen, and that's not a certainty. Anywhere else I turn to is a financial, economic, and military disaster, because to watch people die right or left is never a good thing. So we're in a hole. And if you're in a hole and you have a modicum of control, as OPEC does, and they care about the price of their commodities, what they need to do is to decide by how much they're going to cut. Obviously, the world doesn't need that, because what we need right now is a reprieve, something that slows down inflation. But frankly, it's not OPEC's responsibility. That's more of these central banks and their governments to reduce spending and ensure that the supply chains are restored. And OPEC has to look after its own interests. So they will have to cut significantly. And in order to agree, make those decisions, they have to meet face to face. So we need to be ready for upwards of 500,000 barrels a day cut. That's a certainty.
Okay. Adi Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies. Adi, one would suspect that if OPEC Plus had a consensus, then the Zoom call that has served their purposes so well for 30 months now would have sufficed. The fact that they're sort of last minute having to sort of let's go to Vienna and sort this out would indicate perhaps that they're struggling to arrive at a consensus. Your thoughts as to where OPEC Plus finds themselves and where likely the next move goes?
Good morning. I certainly hope that OPEC ministers have booked their hotel rooms for a while. I don't think it's going to be another 1-minute meeting. I think this is going to be a very, very difficult one. I think economic situation is not great, but one thing we can say about this market is, for sure, is going to be extremely volatile. I'm not quite as bearish, because I think there are some bullish factors out there. Essentially, the way I look at the market is driven by these factors. It's basically the likelihood of recession, which is very, very high. So, that would explain everything that's going on with the macro picture. There is a war in Ukraine, still very unpredictable, with all the sanctions associated with that. And I think that's where the bullish factor is coming in, with European sanctions likely to kick in on December the 5th. Even though the Biden administration is doing absolutely everything they can to try and water down those sanctions. And number 3 is the situation in China. China has been a very big driver of this whole market. So OPEC is very much in an extremely difficult situation. They would definitely like to cut, But this is where my other very strong opinion comes in. I think, and this is where I disagree with Jorge, I think having a major cut would be absolutely disastrous for OPEC, precisely because of the economic situation that he actually portrayed. If it truly we are going into a major recession, Europe is definitely going into recession. We know that. UK is going into recession. Chinese growth this year is going to be negative in terms of demand for oil. Next year is a huge question mark. What is going to happen by supporting prices over and above well over and above where it should be? I think it's only going to be another nail in the coffin of the global economy. So it will only create even less demand. So this short-termism in OPEC, I think, if it continues, and it has been going on for a while, is actually just going to be detrimental to the cartel. So I think it would be a very big mistake. Having said that, the market is not looking brilliant unless we see a major loss of Russian crude production going into next year, which is quite possible. We've seen what happened with gas. It's quite possible. The market is not looking fantastic. There are some bright spots out there, very briefly to throw in. I think product stocks are very low. Especially distillate stocks in both in Europe, US, generally in the OECD are historical lows. And in the US, there is that low that the Congress is panicking enough to demand actually potential ban on exports, US exports, which would be, again, just totally idiotic. But, you know, we can expect anything since Trump, you know, we can expect anything out there. So, yeah, there are some positive things that can happen in case you want to be bullish about the market, but underlying picture is not that great.
Jorge, if we assume, as the sort of consensus appears to be, that OPEC Plus are looking to make a cut, inevitably, to get to that destination, you said there yourself, they'd have to do a 500,000 plus a cut. Now, my question is, from what? They have producers who are producing at quota and would have to cut real barrels. And they have the majority, probably 90% of the countries that are producing at a fictional quota, and they'd be more than happy to cut from quota. So how does OPEC Plus navigate this gap? Those countries that would have to really cut barrels and those who would be cutting, just a shadow.
Yeah, there is always the fantasy number and then the real number. So when I look at OPEC, I forget about the fantasy side and I look at the main producers in the Middle East that do cut or do serve increased production on occasion, right? Saudi Arabia, Kuwait, and the UAE. The rest are pretty much fantasy world. But now among those three, there is
what about addition. Iraq?
Iraq, to be very fair, kind of says the right things, but doesn't do the right things. They have too many budgetary pressures. So you have to really look at the top three. And then nowadays, you have another very important player, and that is Russia. Russia, and this is probably one of the things that I took out of APEC, is there is some friction in terms of the exports from the country. So it would befit them to push for a cut because that would align with the pressures they're feeling in terms of exporting. So they would contribute to that cut, whether that's a willing contribution or a market sanction contribution is another story. But I would say those top four are aligned in terms of reducing production and then trying to swim against the market in effect, because as Adi says, the market doesn't need that. And we're talking about the market as a whole, the financial market, right? But my point is, there is what the market and the world needs, and then there is what you and I personally need, and what companies and countries need. And what OPEC needs is a price that is above $80. If I'm not mistaken, the latest budget by Saudi Arabia very much accounts for that. So they're going to defend that line, and that's their job. They have to look after their own citizens, right? They're not responsible for Britain or France. They're responsible for Saudi Arabia and Russia and the UAE. So it's those four who are going to cut. And I think based on where the market is, and they have been, is a very easy contribution of a minimum of 500,000 barrels a day. But I think we should be ready for a little bit more. And then, and I'm sorry for taking too much time, if we overlay that cut on top of, as Ari has mentioned, the low inventories worldwide and the potential return of China, we could have oil counter-trending the overall economy and actually putting another nail in the coffin, right, of the overall economy. The overall economy is bad, is sick, is disastrous, and I don't know a way out that is painless.
Adi, I mean, that was my next question, and I'll still go with it. I mean, OPEC Plus are enjoying a year in which Brent is averaged $105 a barrel. Brent is currently 85, seems to be quite attached to $90 a barrel under current market conditions, without China, without the sort of implementation yet of the European embargo on Russia. I don't see the stress in the market. I mean, I do see, if I'm sitting in Britain and the sterling's falling through the floor, I think the house is falling down. But nonetheless, global idle capacity is under 2%. 5-year averages are way down. SPR is 30, 40-year lows. There's really fundamental. We're one headline away from $100 oil. As you know, Putin says, "Oh, sorry, the compressors are broken this weekend. We're shutting off." I mean, I don't see the argument for the stress that Jorge is advocating. Your thoughts on that?
Well, you know, you've thrown quite a few things in there.
Yeah.
Well, first of all, as I said from the beginning.
Well, I'm throwing in the bull, I suppose.
Absolutely, but it's a really fluid, really complicated situation. I totally agree with you. Let's not forget one thing we haven't mentioned, that now that we're going into, at least in Europe, into major refinery turnarounds. We're going to do either voluntary or involuntary. We're going to lose about 1.5 million barrels of refining capacity in October, at the time when distillate inventories are at historical lows. So, you know, in the US, refineries have been running for quite some time. They've been enjoying fantastic margins. So they've been running well over 90%. Most people in the industry would know that when you run a refinery for a long time, for anywhere near 90% for a long time, you're very likely to have, excuse me, breakages and outages. And we saw the unfortunate disaster in the Whiting refinery, BP's refinery in the US. And if they continue this rate, it may well be more. So there are a number of bullish factors that can happen out there. Most of the demand projections now that have driven this market down to $80 were based on this revision of Chinese demand from almost 5%, 4.5%, down to close to 2% for next year. But you're absolutely right. We could see some stimulus coming out in China. And if we do see demand in China going back to sort of 4% and above, this market will easily go over $100 a barrel, whether Europe and US like it or not. And the situation in Russia being totally fluid, as you said. So it's the only thing we can say with certainty is that uncertainty is going to prevail in the market. That puts OPEC in a difficult position. And quite frankly, if I was OPEC, yes, OPEC do look after their own constituency. But I think the best thing OPEC would do nothing, because right now they're opening Pandora's box, where new quotas would have to be, unless, as Jorge says, the core, i.e. the big 2 or 3, let's throw in Kuwait, or 4, including Iraq, the top 3 core Gulf players do something themselves, it's very unlikely to see any cut coming out of OPEC. They may actually agree on a cut, but then if it's a proper cartel type of cut that will work, it will have to be based on agreed new quotas, which I just don't see them doing this time in October. It'd be way, way too hard. Now, of course, Russia may well promise a major cut themselves and then just say, but I think they'll just talk the talk. Whether that's going to happen or not is very unlikely. And they can promise it because it is very likely that because of the sanctions, they are going to lose particularly some product exports next year.
Jorge, I'd like to give you a chance to sort of rebut my thesis to you. And the question of how do you get around the point of $85 is still a big number. I don't think in the history of OPEC that I can remember they've ever cut. I mean, this last month was a bit of a joke, whatever you want to call that. But ultimately, to make a significant cut at a price of $85 on Brent, I think it would be unprecedented. And they do have to think about not killing their customer.
Well, and here I'm going to share a little bit of what happened in APEC last week.
Yep.
There is an economic consensus that the bottom is falling out of the European economy and that the bottom is falling out of everybody's pocket because interest rates have risen significantly. And all of us are facing a doubling or tripling of the interest rate portion of our mortgages. And this means that on a personal basis, our disposable income is being picked by the Fed. And this is a situation that is being faced by every major corporation and country. That's why the bottom fell out of the market of the gilts in the UK. There is a loss of liquidity globally that I have never seen in my lifetime, and it's extremely fast. The Fed have overplayed their hand, and they're really picking everybody's pocket. As that happens, and we lose the disposable income, our ability to consume not just oil, but anything else disappears. And if you incorporate that loss of disposable income into the overall economy and spending habits, the consumption of oil will drop. It's unescapable. And therefore, if OPEC cares about maintaining a modicum of price that is above 80, it has to cut. It has no option. If it doesn't cut in the discussions I had in APEC, what are we seeing? A bottom of 60, a bottom of 50, or worse than that? But this is coming. And it's coming in this quarter, regardless of the war, regardless of the inventories, regardless of anything else, people have no money. When you have no money, you change your spending habits. So it's very serious.
It's very serious. Let's go to the survey question because I wanted to take advantage of having you two on the podcast today, probably two of the world's leading voices on pricing of oil. And it's an absolute honor to have you both on the podcast. But I wanted to address this question of Russian oil coming east of Suez into Asia and the Middle East, while refined fuel produced in this region of the east of Suez is flowing to the west. How long will these changes last?
Okay,
that's the question. And sorry, Jorge. And the reason I want, that's my setup to you, Adi, you could kick it off first. We saw recently dated Brent be restructured with WTI because of the change of flows out of America over the last 7 years. My question is, are the benchmarks east of Suez fit for purpose now that we have a whole new direction of flows?
Yeah, well, first of all, answer to the question regarding the timing of the flows. I think it's really hard to say. I think these flows will continue as long as the war in Ukraine continues. Will it be months or years? It's very, very hard to say. I think at the end of the day, there will be a negotiated settlement. There's no other way. I mean, unless we go into some horrible scenario. So. And I think nobody wants to bleed forever, neither Russia nor Ukraine. And I think at some stage they will have to reach some sort of conclusion.
Well, let me just challenge that, just as you're bringing it up now, the timing. The 1970s, when we had a similar embargo take place, the Arabs on the West, those flows changed for decades.
Well, I mean, exactly. You can.
Even if you're back in love with each other again, the flows change. But
but they won't, Sean, simply because these are very inefficient, uneconomical flows. It's very expensive to move oil from the Baltics into Asia and to move Murban from the Gulf into Europe. It just doesn't make sense having tankers past each other in the Suez Canal and choke it. So economically, it doesn't make any sense. So obviously, as soon as the situation changes, the flows will change. Now, I don't know when the sort of war Ukraine ends. So there will be the end of that. Excuse me, got a bit of a cold. And the key question on the benchmarks is, well, if anything, as a result of these, as a result of the war, I think we've seen more US oil coming to Europe to as much as 1.6 million barrels a day, making WTI extremely important in Europe, making even a stronger case for inclusion of WTI into Brent. East of Suez benchmarks, are they fit for the purpose? No, not yet. It doesn't mean that they won't be. I really hope that they will be. I think there's still, benchmarks, as I'm sure Jorge will confirm as well, take years and years and years to develop. They don't just happen overnight. Particularly Murban, I think, has a very good chance to be, as I always said, a strong benchmarks, but needs some major changes in there in the contractual terms, which I've sort of made very public before. So does that matter? I don't really think it matters. I think it's good for East of Suez, for the Gulf, to have their own benchmarks. The more benchmarks we have, well, the more contracts we have, the better. I think traders are quite happy to have more instruments out there available to them. Now, which ones they pick and choose, I'm really not sure. It really depends on traders and very much depends on what happens with Brent. Brent is critical because if Brent becomes a success, and it's really down to the players, Brent players, not Platts or Argus or anyone else, it's down to the players to make an agreement to make it a success. If it's success, things will work out as they have. If it's not, I think that becomes very interesting because Dubai is very much linked to Brent. It's the flat price of Dubai is derived from Brent. So Dubai is essentially a derivative of Brent. So if Brent collapses, Dubai will collapse too, and then the market will have to look for something else. And that will be likely to be one of the Murbans, Omans, or I&E contracts.
Jorge, welcome your thoughts. Go ahead.
I'm going to have impolite ones.
Yes.
In none of my meetings, anyone talked about Murban and its price. So you can park that somewhere close to the door. It's not happening. The people are talking about Brent, but in terms of it's breaking down. It's not functioning, but it is the benchmark. And as Adi says, everything is referenced to that. The big shocker of OPEC is the following, and I'll share it with you. The tradable spot barrel right now that the whole world is talking about is euros. It's not Brent, it's not TI, it's not Oman, it's not Dubai, it's not Murban, it's euros. Everybody's talking about spot euros. Now it has big issues. It's not transparent. Nobody knows what it is trading at. Definitely the publishers have no idea. The market, of course, knows. And it's close to $10 discount, something like that. But I don't publish, so I don't have the certainty. But it is the spot barrel. Any margin, refining margin, is now calculated in relation to euros because it is the marginal unit feeding the refineries. That's the big change that no one was forecasting that has happened in the last 3 to 6 months. So when you impose sanctions, they have unintended effects, usually the opposite. But your question was, how long do these things take? They take years, as you have mentioned. Pipelines are being reset, ports are being reset, contracts are being drawn out. All these things distort flows for years to come. The loser, sorry to say, is Europe, because as Adi indicates, it is paying double or triple freight because of the sanctions. And this condemns the livelihood, lifestyle, comfort industry of Europe for a multi-decade decline. We have to take into account that lifestyle in Europe will not be what it has been. And this is what is weighing on the total economy. So you cannot meet a guy more than me that wants the war to end immediately and all the supply chains to be restored to what they used to be for all of us to start negotiating. But the main impact is that euros is now the spot crude of the world. Imagine that.
Is there any argument, Adi, for Urals to be included in Brent in order to reflect? I mean, WTI is now being, from next June, will be in dated Brent. Given Urals' global place now, should it be considered for inclusion in the same?
There
No,
is what your mind says from a reasonable point of view, and then there is what you need to do from a corporate or national point of view. Urals has no chance to be included into the Brent basket because that would be seen as supporting the Russian. So it cannot be done.
Adi, your thoughts on that? I mean, if it can't be done, but should it be done, or without it, does Brent represent flows into Asia now? Given this, I mean, Urals is it the biggest into China? Certainly, Russian oil is now the #1 supplier into China, the world's biggest.
well, let's sort of talk about pre-war and war
Yeah.
situation. Even pre-war, there was some talk of inclusion of Urals, and that really never happened. It never happened simply because Urals is different grade; it's sour grade. Secondly, it's to have a grade that's included into a benchmark, you really have to have a freely traded grade without much control of big players, and Urals would have never got that benchmark status simply because there are too many big players like Rosneft. They can actually control it, influence it, either directly or through their proxies, one of the 2 or 3 big traders that have contracts with them. So that was out of the question. So Urals always been interesting, important benchmark as a regional benchmark. What I just want to correct a little bit what Jorge said, not to correct, but clarify it. Now in Asia, Urals is a marginal barrel, but it's still tiny. But it's marginal. Marginal barrels are important for price. Now, to clarify this calculation in Urals being a benchmark, absolutely not. All the refineries are still running their LP models relative to Dubai. What they're doing is looking at sort of Dubai-related grades in terms of price relative to Urals, because Urals has been offered at huge discounts. In Asia, a little bit less, because obviously there's been more competition, given that Urals been going there, plus the freight, insurance, and everything else is more expensive. So forget it. Forget about Urals being any benchmark anywhere. People are looking at it because it's important, because that's where they're making money. If you're an Indian refinery or Chinese refinery, especially independent, you will obviously very seriously look at it as a marginal barrel. But as a benchmark, no chance. And after the war, just, as Jorge already mentioned, just forget it for lots of other additional reasons.
Jorge, the idea that we're seeing in the Gulf now, with the Saudi minister made the comments a few weeks ago, again back to the doorstep of OPEC Plus, that the reason that it sort of started this new conversation was the volatility in the market was detrimental to hedging, was detrimental to investing, so it was not the price that was the issue. It was the volatility that needed to be removed in order to allow sort of the physical and the paper market to come back together and so on. I'm wondering your thoughts on that argument. And if that is the objective, then what is the best decision by OPEC to achieve that objective? Not to achieve the highest price, but to achieve the removal of volatility.
Yeah, volatility means something different if you're a producer or a consumer. For a producer, volatility means declining prices. If you're a consumer, volatility means rising prices. And the two sides have very different ideas what a stable good price is. The producer wants a higher price and the consumer a low price. And this is why there is a market. The market defines where it is. But there is a point now, because of the cost of capital, because major entities are suffering liquidity problems. The overall liquidity in exchanges has dropped. The volume has dropped. Everything is shrinking. You need to see the price of the stock of CME and the price of ICE. I don't hold those stocks, but my friends say, 30%. We have lost 30% easily. And that's a reflection of the inherent liquidity of those markets. So there is an issue with liquidity, volatility, margining. Margining has become a huge issue. And this will result in additional loss of value for those companies and inability to hedge properly. We also need to consider that in the next week, I think there is a likelihood of major central bank intervention starting Monday. If they don't do it, Credit Suisse is very close to the precipice, if not over. Somebody needs to pick them up by the neck and say, you're back on the ground. So we are facing really serious issues. I don't want to say in my lifetime, which I used before, but this is very reminiscent of the 70s. I'm old enough to remember that, but not many people are. So it's in their lifetimes unprecedented. It's so serious. Really, my point for this discussion today is it is so serious. And it requires global market intervention, which essentially just kicks the can down the road. The governments have too much debt, and that essentially will either bite us this year or will bite us in 10 years, but eventually it will bite us.
Last word to you, Adi. Well, let's get the survey result before we post it on social media and see what the view of the room is, at least. Months, temporary, years, decades. Adi, I wanted to get your opinion on the product side of this story. As you know, for a very long time and still to this day, MOPAG, netback out of Singapore, is the products contract that's used to price products moving out of the Gulf. But in the next year, and it's already started, we have over 1 million plus new barrels of refining capacity in the Gulf, with Zohr at 600,000 in Kuwait, Jazan in Saudi at 400, and Oman's Duqm at 300, all in some phase of a stage of coming to the market. Given that scale of products, increase in product refining capacity in the region, is MOPAG still fit for purpose, or does the Gulf now need its own reference price? Your thoughts on that?
Well, I think Mina Platt's base is, I think, look, this is something that's been going on for quite some time. The problem is that Singapore is still the place where the sort of most of the trading happens, and most of these prices are netted back from Singapore. And it's reinforced by the fact that now, when it comes to products, it's a really interesting situation. First of all, just to say, I think thank goodness for these refineries for coming online, because what is happening in terms of products, the way at least I see it, within globally, there is excess capacity for refining, which is a good thing, and the refinery margin should generally be low. But we saw what happened this summer. There was a major blip in refinery margins, and the main reason for that was China. Chinese exports of products have been extremely low up until now, until we see the latest quotas. And even that is a question mark whether it's going to be rolled into next year or not. We don't know. But anyway, China is the key. Without China, the world has no excess refining capacity, making product situation extremely tight. And thank goodness for these Middle East refineries to come back. I think it's a good thing. Now, with China actually responding finally to global markets, as it should have responded this summer, but of course it's politically driven. Now, hopefully we'll see some relief in the products market. And we saw as soon as the Chinese quotas came out, was it on Thursday, I think, it came out, I think a gas oil crack fell $5 immediately in Singapore, and jet crack came off, I think, about $3.50 immediately. Came back a little bit, but so it was a big impact. China has a huge impact, not just in Asia, but globally as well. So it's just down in terms of benchmark, very much something I'm sure you'll be discussing in your forums. Something that needs to be seen, a player for something to change over to new benchmark really takes a while. And I still think
just on that point, I mean, the fact that China's obviously has the potential to flood Asia with more products, but now we have this new flow of AG products going to the West, right? And that could grow, whether it's temporary or permanent, it could grow significantly, enhancing the argument that for an AG price and not a MOPAG Singapore price.
Absolutely, and it would. But the only problem is for players in the market to actually move on to another benchmark, you have to say that this is not temporary, it's going to be permanent. Don't forget that, well, first of all, Europe definitely badly needs that product. Plus, you'll have a major move if this December 5th sanctions really seriously kick in and prevent Russia from selling things in Europe. You'll see a major, even bigger flow of products going elsewhere. And we actually think that out of, let's say, 1.5 million barrels of products, you'll probably only be able to place 2/3. 1/3 is very questionable whether that can be actually placed anywhere other than storage. So it's a very fluid situation, Sean. I'm sorry I'm sort of saying this, but it's complicated.
Well, it sets us up for more discussion. What I'm very sad about today is the fact that you two gentlemen will not be in Fujairah with us next week at our 10th anniversary Energy Markets Forum as two of the brightest minds in the business. We're delighted to have you today as a curtain raiser for our gathering of what unfortunately seems like a bunch of hungover people on their way back from APEC. So they will have a half a brain, it seems. Any of them I've met or I've talked to in the last few days, it's like, my God, what happened in Singapore? Thank God I didn't go, or I'd probably be sick for a week. Anyway, Adi Asimovich, thank you so much. As always, amazing. Jorge Montague, it's so great to have you back. Enjoy your time in Thailand, and we look forward to talking to you both soon again.